Hi, everybody. This is Eric Burkholder here with Jordan Bradford, and we are here to give you guys a quick market update, economic update. It's been a while since we've talked about the markets, and it's been quite a year, quite a first half of the year. And so, hopefully we just give you guys some kind of thoughts on what's happening and our views. We can answer any questions you guys have as well. So, Jordan, kick us off. Tell us what has happened so far and what's going on.
Yeah, well, as you know, right, a lot's been going on in the markets in the second quarter, and we're just started the third quarter technically here, but there's been a lot of different stuff going on. We still have what's going on in Ukraine, obviously, but here in the U.S., I think some of the biggest economic talking points has been inflation and interest rates. And just, what's that happening, as well as, GDP. And are we in a recession? Are we going to be heading into a recession? And there's a lot of economic indicators out there and things that we're going to be getting some information on here very shortly that should give us some more, insight as to, where the market's headed or where the economy's headed at least.
Yeah. Before we go on what's on the horizon, let's talk about some of the things you just mentioned. So inflation's one, obviously running very high, historically high, and I think some expectations, certainly from Fed officials and things, were that it was going to moderate before now. That hasn't happened, and so you mentioned the Fed is going to make some decisions on interest rates, and it's certainly a concerning thing for the market. We haven't seen anything like this since probably the 80s. So kind of what has the Fed done so far, and maybe give us a little info on what's leading or what's causing some of this inflation.
Yeah. So obviously the headline has been inflation, 9.1% here in the U.S. And we're not alone in this though. Globally, inflation is going up as well. The U.K. hit 9.4%. for inflation as well. So this isn't just a U.S. problem. This is happening in Europe and in many other developed nations across the globe. We're seeing that rising cost of goods everywhere. But I think the Fed is doing, a number of different things to help offset that and to help us to essentially weather this inflation storm here in 2022. Probably the most notable is raising rates. Back in mid-June, the Fed, to some degree a surprise, they raised rates by 0.75. So that's, 3/4 of a percentage point, which the Fed had not raised rates by that much since 1994. So, that's a pretty big deal that we have seen the Fed, be able to react and act on the news, which is that, inflation is just running a little hotter than I think anyone really expected. So that's a number one tool really in the Fed's tool belt to be able to combat that. Right. The expectation is that not if the Fed's going to raise rates this week here, but how much. And I think if you look across the board, you have some people are predicting 0.5%, some are predicting another 0.75. And now I'm seeing, there's plenty of economists out there that are suggesting that the Fed may consider raising rates by even 1 percentage point. So I think everything's on the table at this point for the Fed to try and slow down this inflation and kind of get the economy to just cool off just a little bit. But we obviously have a lot of other news with GDP too.
Right. Yeah. So that's a good point. We're really at this perfect storm of economic things happening where hopefully the Fed can kind of cool some of that inflation, but we also have the advanced estimates of second quarter GDP coming out next week, and so there's some concern that we'll find out we were in a recession. I think a lot of people are saying the odds are we have been in a recession, and so now you've got Fed raising rates, which is supposed to slow inflation, also as a secondary effect can slow the economy, while also potentially being in a position that we need economic growth. So a lot of things happening, and we're certainly seeing that be affected in the stock market and bond market.
Right. Right. And it's kind of unusual because we usually don't see the Fed needing to raise rates at the same time that we're talking about GDP shrinkage. So that's kind of a strange environment that we're in. And on top of all that, there's mixed signals even from the economy. While inflation is really high, consumer spending still is pretty good.
Yeah, came out better than expected this week.
Yeah. So it's just a little bit unusual. So I think that while we may be in a recession, it's possible that we're in a pretty mild one.
Right.
And the market's really priced a lot of that in already. In fact, I think, roughly at the time of filming this video, the market, or the S&P, is down about 17% for the year. Typically, 20% would be a priced-in recession, and we've hit that already. So the market's kind of bounced back a little bit this week, but overall, we have seen the market basically priced in a small recession here for 2022 already. So I think that these GDP numbers are going to be very telling.
Right, exactly, and I think you hit the nail on the head with almost all the times when we're trying to think about the markets in the future. Is there's a lot of mixed signals, and I'm sure a year from now, if this was the worst it got and the GDP numbers came out better and inflation went down and the economy is rocking and rolling, people will be like, see. Consumer spending, it was better than expected, and employment was very low. We should have seen this coming. If we end up getting a worse recession, people will say, see, inflation was high and the GDP numbers were weak. Like, you should have seen this coming. And so I think a key point is that the market prices in all the information we had. As you said, it really looks like it has priced in the known information. The future is what we don't know. Anybody who says they know what's going to happen, they've got a better crystal ball than I do. I wouldn't trust them. It's only in hindsight people claim they knew it was going to happen. So we can, though, still use this information to build portfolios that hopefully will withstand all these different types of markets and uncertainty. And so we can definitely talk about kind of how all these things in the market are also affecting the investments so far this year. And I think a new thing to a lot of investors, unless you have to have been investing for probably at least 30 years to have seen bonds go down because it's been a long bull run. But we are in this situation where equities and bonds are down, and so I think a key thing to consider there, or to think about, and something we really implement in our portfolios, is making sure you have the right balance. Most of our retirees still have more equities than they do fixed income. And that is because when you have high inflation, when you have higher rising interest rates, long-term equities will keep up with inflation. Typically, they're a much better hedge against future living expenses and growth than bonds, because bonds can still be down.
Right.
We're seeing a lot of people were reaching for yield. They were trying to get junk bonds or like 30-year treasuries just for that yield. And now those bonds, how much are those down this year, Jordan?
Long-term bonds, are looking in the ballpark of being down around 20%, which is, that's equity numbers there.
Right. Yeah, that's a tough number for fixed income investors to stomach. And so we really, here at Burkle Wealth Management try to preach diversification, a balance in your portfolio, or, depending on where you're at in life. But, there's risk to everything you do. There's risk to equity markets, to fixed income. There's risk to keeping money in cash when inflation is 9%. So, I think another thing to point out is values held up very well. That may be lost in the news of everything being down. And I think you had some of those numbers too, as far as the outperformance on value.
Yeah, across the board, when you look at, small value, large value, and even the mid-sized companies, value portfolios are down roughly 12-13% for the year. And if you look at the growth side of the market, it's basically down about double that. 26% is really the average that the growth portfolios are down. So, it does go to show that, diversification is not just, different sectors of the market, but different size companies, different duration for your bonds.
Right.
We want to be diversified across a lot of different areas, so that portfolios can withstand times like this where, things just are acting a little weird in the market.
Right, exactly. And, part of our job is to always be forward thinking. And last year when tech was just ripping it and everybody was moving into growth, Now we're seeing the flip side of that. Is typically when something has that much volatility on the upside, you get it on the downside. So, trying to make sure we have the best diversified portfolio we can. And then moving forward, having a plan. As I mentioned, we know what's happened. We know what the market's priced in, but we don't know what's going to happen going forward. And so having a portfolio that's built to withstand whatever happens. Right. And it cannot be based on predicting what's going to happen because we don't know. And the big mistake people make is not riding out a 20% downturn. It's getting out at the bottom.
Yes.
That's the big mistake. It still happens. And that is what will wreck a financial plan. All we can do is be prepared for it. It's like the weather, and I think you brought that up on another podcast. We can't, if you made you decided to live where it was only sunny all the time, that's not realistic to avoid every storm, every tornado, every hurricane. And so if your plan is based on that, it's going to fail. It's much better to design your clothing and your house based on we know we will have storms. And so we can weather it. If it's designed correctly, we can't always avoid it. And so I think that's where we will probably wrap it up today. It's been a rough year. We acknowledge that. We feel good about where our clients are at, and we're putting work in every day to make sure they're in the right portfolio for their situation. And that's all we can do. And if it's done well, it should work out. But it's been quite a year, and doing this long enough now, a lot of years are in some way like this.
Yeah.
Now they're not down always, but there's always uncertainty, and so we're here to help you guys navigate it, help you have a solid plan, and of course, if you have any other questions, we can help you. Anybody out there listening, we're happy to help. So.
Yeah, thanks for your time today, and continue to tune in. We're going to keep providing you with video updates throughout the year on all sorts of different topics, not just market updates, but anything that may be relating to your financial planning needs and goals.
Yeah. So thanks for joining us today. We will see you on the next one.